Welcome to our CIO market update. A lot is going on in markets. We've seen a strong sell-off yesterday, especially in Europe in the banking sector. Credit Suisse came under a lot of pressure. There's a confidence crisis at play. Today it looks much better already, thanks to announcement by the Swiss National Bank providing liquidity to Credit Suisse. What does it mean for markets? What does it mean for the outlook, our view on the current situation? And so therefore, on short notice, we invited you, and thanks for joining to today's call. My name is Felix Brill. I'm the Chief Investment Officer of VP Bank. Now, that markets are wild. We've seen really in the last couple of days, yesterday, super strong sell-off, especially in Europe. European banks came under pressure, starting with Credit Suisse in the morning when the Saudi investor said in a Bloomberg interview that they won't add any more support in terms of capital to the Credit Suisse. So that spooked basically markets. There was a big sell-off in Credit Suisse, more than during the day, 30% drop, after already dropping in recent weeks quite a bit. So that added a lot of stress and a lot of uncertainty to markets. There was kind of a confidence crisis at play, and we've seen that basically across Europe then. Other banks also under pressure. Overall, the European banking index was down yesterday 7%. Now today, I'm happy that we talked today. Things look a bit better. Yesterday evening, the SNB, the Swiss National Bank, and the authority, the FINMA, they announced that they will support liquidity to the Credit Suisse, which helped to stabilize the situation today. Basically, the drop of yesterday almost reversed at Credit Suisse, and overall, it's looking a bit better. But still, the question is, was this everything basically, or do we see more risk for contagion now? If you look at these two charts on the left-hand side, you see that markets were wild, but on the right-hand side, that chart illustrates that it might not be completely over. We see mounting stress in the interbank banking market. You see that in the spreads here. They went up quite a bit end of last week. And so therefore, it was really quite important for the FDIC and the Fed over the weekend, and now by the SNB really to step forward and to announce to support liquidity in order to address these stress symptoms in the banking industry. Otherwise, like there might be ripple effects and a domino effect going forward. Now, it started all last week, basically, with the failure of SVB, basically came to light Wednesday evening and Thursday when investors or clients withdraw, I think it was $42 billion in deposits from SVB, a bank that had a bit more than 200 billion assets under management. So something you basically cannot deal with as a bank. So kind of a typical bank run. And the reason for that was that can be found basically to a large extent with kind of bad risk management and management failures at SVB. So they had a way too risky investment portfolio. They invested around 60% of their assets into government bonds and mortgage-backed securities, compared to like on average of the 30 biggest banks in the US. It's around 23%, so more than twice as much. And on top of that, they did not hedge their interest rate risk. So what happened basically last year, when interest rates started, you accumulate a kind of negative impact on your bonds, right? So basically unrealized losses. That's typically if you held and booked these assets until maturity. That's in normal times not an issue then, because if you have US Treasuries in your book, you get 100 back when they mature. But now, when then you get into a situation where clients withdraw liquidity deposits, and you get into a liquidity situation, then you have to realize potentially these losses. And that was the main issue with SVB when they had to announce that on Wednesday evening, and then on Thursday. Now, is it over? Obviously not really, as we've seen over the last couple of days. And I think at the same time, it was very important that authorities stepped in, because we've seen already on Monday, even though we've seen the announcement that deposits are guaranteed above the $250,000 that are normally guaranteed in order to calm markets and prevent basically a contagious development. Even then, regional banks in the US dropped by kind of 60-70% on Monday. So that shows if these guarantees had not been issued, what could have happened. Now, yesterday, additional stress, as I mentioned, in Switzerland. Now, where do we stand? Just before I move on, here, a quick reminder, please feel free to look also at our research portal. We cover all these developments there. We published on Monday morning our first assessment on SVB at the morning at 7 o'clock. So please feel free, or also to reach out to your client advisor if you want to get these updates in your email inbox. Now, the question is it over by this announcement by the S&P, for instance, and by the Fed, because they provide liquidity and like that can help, of course, and we see that today, to calm markets, to regain confidence. But the challenge remains that central banks can not only focus on now the financial stability or financial crisis situation, but they still have to tackle the topic of inflation. So inflation has not disappeared into thin air, and we see that on that chart here on the right-hand side. You see basically that I show here the core inflation, which excludes prices for energy and some food components, that this core inflation is still quite elevated. In the United States, we got the most recent data on Tuesday, came down to 5.4% in February. In Europe, in the Eurozone, it went up actually in February to 5.5%. And if you look at the light blue line in that chart, that is representing the line for Europe, there is still a positive trend. And that is the challenge, that central banks face still the risk that inflation stays elevated or even increases further. And therefore, they already started and did that quite, as in case of the Fed in the US, aggressively tightened monetary policy. Now, what we've seen basically at SVB and in general, like these developments on fixed income markets, is kind of the side effect of that. But they didn't do that because they just, wanted to do it because, it's fun or whatever. No, they had to do it in order to deal with inflation. Now, inflation is not over. There's still a risk of inflation. So they have still to do that and now also deal with the side effects. And that makes it really difficult. So we think central banks will, of course, take that into account. We see the ECB later today. It was widely expected that they deliver another 50 basis points interest rate hike today, as they are still trying to catch up to the Fed. And as you see on that chart, inflation is still rather increasing, the underlying inflation pressure. We will see if they stick to the 50 basis points, but I think ECB President Christine Lagarde will still stress the point that inflation is not over. And so that is something to watch out, and it's very important later today to see how the ECB tries to find a balance between inflation and financial stability on the other hand. And then the same we will see next week by the Fed and the Swiss National Bank. So this is really something to watch out for. We think, in our view, the Fed, as of today, this can change tomorrow, but as of today, it's still likely that they do another 25 basis point hike, not 50, as some participants speculated last week, 25, and then most likely pause and monitor further developments. But there's, things are moving very fast, and we have to monitor that closely. On the positive, as a positive note, as I mentioned, it's really good that they kind of stepped in, the Fed and the S&P, in order to provide liquidity and in order kind of for adding confidence again to the market that banks, like that liquidity crunch or liquidity crisis is not getting out of control. But, however, there's another side effect of all that what I just discussed, and that's the impact on the economy. Ever more so, we have to expect a recession in the United States. What you see on that chart that put on screen here now is, on the one hand side, that's the light blue line. That is kind of I would say the lending, the credit lending standards or credit standards of banks for small and medium-sized enterprises. It's based on a survey, the senior loan officer survey, and we compared it here with the GDP growth of the US economy, right? And you see there's a very close relationship. And the last survey has been conducted previous to the recent market turmoil. And already there you see that financial conditions have worsened, have tightened. Banks became more restrictive for the lending standards. And we have to expect that this even intensifies because now they have to make sure that they're really good on the safe on the liquidity side, so they don't want to risk to have credit losses and don't be too exposed there. So that is a challenge now, and this means that basically we have to expect more kind of more negative impact on the economy stemming from that side. So it's not only now more expensive to get credit, being it for companies, they want to invest into a new production side, or for getting a mortgage, or for the credit card. So interest rates are higher for sure, so that makes it more expensive. But on top of that now, banks most likely will tighten their lending standards further. So access to credit is now more and more an issue, and that is negative for the economy. So we have to expect a recession in the United States and basically also in Europe. And that is a bit the challenge. The challenge, and also beyond, let's assume at some point we will get beyond that uncertainty crisis, confidence crisis right now, with the starting point maybe today. But beyond that, it still remains challenging, because the kind of the environment, especially for companies and then for equity markets, is challenging. And based on what we've seen over the last 10 years, or almost like 25 years, where basically performance was coming from, what were the performance drivers, you can probably relate to that statement. You see that on the left bar, where we show the different components basically for return. And you see a lot over the last 10 years was stemming from multiple expansion, meaning basically falling interest rates, right? Now, interest rates are much higher than on average over the last 10 years, and most likely they will stay, given the inflation outlook, kind of at elevated levels. So it's hard to imagine that we see a boost from that side for equities beyond like the next couple of days and weeks, but rather for the next couple of months. So that is a challenge. And on top of that, another important return driver are profit margins, and they will come under pressure as well, given the recessionary outlook, and on top of that also revenue growth. So you see, if you dissect basically these components, it's not really fundamentally a very positive outlook for equities on top of the kind of risk-off environment currently. So therefore, we stay, and we decided that on Tuesday in our investment committee, but we also discussed it, of course, yesterday. We decided to stay cautious in the portfolio stance, meaning we are underweight in equities, strongly underweight, so by being underweight in US stocks and European stocks. So now it's not time to kind of try to time the market. That's usually already difficult, but now I think it's very key to be cautious. And with that, being cautious means also for us being overweight in bonds. and focusing on high quality bonds, so very good credit ratings and not a lot of credit exposure. We've seen treasuries kind of, and also European government bonds really benefiting last couple of days, and now at a different level, right? Because interest rates are higher than last year. Now we can also move downwards again, and this adds support to the portfolio. And the third aspect or recommendation, we have to make sure to have enough liquidity, because in a situation like now, where markets can be really wild, you can really see extreme moves, as yesterday, for instance. You don't want to be forced to sell something. That's very key. Basically make sure to avoid a situation where you're forced to act. So that is always key in situations like that, and that the chances are also good that you won't get into these kind of confidence crisis too much involved in that. Finally, but I really want to stress that point, that what we've seen yesterday, what we've seen on Monday, and then also on the positive side today, it has to do with confidence. And we can't predict where confidence is going to tomorrow or the next couple of days. We can't do that. No one can predict that. It's about psychology, and we have to be aware of that. So I can't promise you or predict you what happens tomorrow. That's the nature of the situation we're currently in. I think, as I outlined, we still, we see the support of central banks, we see the support of authorities. That is key. Communication is key to provide confidence again. We face challenges for sure in the overall environment, but now in the short term, it's a lot about communication and how authorities will react. There is a chance then that this confidence is not only reboosted today, but for kind of in a more sustainable way. But unfortunately, we have no guarantee for that, and we have to be aware for that risk. And with that, I'd like to conclude my remarks, but open now the floor for any questions you might have. And I see that here on that tablet there, 2 questions have already come in. First question, not really surprising, I must say. What about the position for VP Bank, its credit policy, etc.? Well, to be fully transparent, I'm not allowed to talk about VP Bank, and that good reasons for that from the regulator. We are not objective, right? We are involved. And that's not only the case for me talking about VP Bank. No analyst of UBS is allowed to talk about UBS. No analyst of Morgan Stanley is allowed to talk about Morgan Stanley. So unfortunately, I can't say anything on VP Bank specifically. I can offer you only 2 things. One fact, kind of factual a hint on facts, that we are, of course, have strict regulation and requirements from our local authorities. That is for sure. That's transparent, what we report on that. And above that, we have also, I think, a statement from our communications department. So if you're interested, please reach out to your client advisor or to our communications department. They will provide you with an official statement of VP Bank, but I'm not allowed to provide you any details or an assessment on VP Bank, which is good for you, actually, and also for me. In the VP Bank, the next question, in the VP key figures, there's a line income from trading activities. Can you elaborate? I can cut this question short. Again, I'm not allowed to talk about that. The third question that came in, do taxpayers have to pay once again? Probably relating to both the SVB rescue or support by the Fed, and now the Swiss National Bank providing 50 billion Swiss franc in liquidity to Credit Suisse, as we learned this morning. Now, this is not kind of, it's not a given as of today that this will result in any cost to the taxpayer. What we see right now is providing short-term liquidity. Central banks can do that, have always done that, and in most cases, basically this is kind of a bridge support, which will not result in any cost to the taxpayer. But even if things would deteriorate and you need more, like what we've seen in 2008 when the Swiss government had to rescue UBS and to step in, actually interestingly, in the end, the taxpayer in Switzerland did not have to pay anything at all. The government provided kind of that bridge and like went into kind of a risk situation, took the risk on the taxpayer's kind of balance sheet, but in the end, there resulted even a profit out of that. So the message or like the answer to that is, I don't know, but we don't have to expect for sure that taxpayers have to pay for it. It very much depends on the further development, and some of the liquidity that or like the support is also then covered already by funds that banks had to pay in over the last 10 years. That was one lesson learned after the financial crisis. Another question, why does the Fed not cut rates immediately? Well, I think it has a lot to do with what I outlined or explained earlier on. It's not, it's not just one challenge the Fed faces right now, namely providing financial stability and supporting the confidence to banks. They try to do that, as we've seen over the weekend, but at the same time, inflation is still a challenge, and they want to make sure that they kind of don't lose that challenge out of control or out of sight. So the room to maneuver is much more limited than in previous years where inflation was not an issue at all. This might get easier over time, especially if the recession unfolds. That will lead to lower demand and so on and so forth. So there's a good case that inflation is coming down later this year, which then at some point will allow also the central banks to focus once again more on that part of the equation. But in the short term, the room to maneuver is not super great, and that makes a bit of a challenge. And in our view, explained, or it's a reason why it's very unlikely that central banks, the Fed particularly, will cut rates immediately. So it can happen, but then this would basically mean that confidence crisis gets even more kind of intensified. Another question, what is the likelihood that other mid-cap financial institutions in the US have gone long on US low-yield paper, thus stressing asset mismatching and increasing interest rate exposure risk? Well, indeed, there are, and also we looked at the data, analyzed banks. What we've seen, especially, I referred earlier on the share, or like how much SVB invested in bonds compared to the overall assets under management. It was around 60%. The average for the biggest 30 banks was, I think, 23%. So you see already there, SVB was much more aggressive. And if you look at the detailed numbers, actually, SVB was the most aggressive of all the other banks. And so there are other banks, smaller banks, that are at risk, smaller banks potentially, because they have also unrealized losses and they have a bit more aggressive than average or some of the larger banks. Overall, if you look at the numbers from the FDIC, in the United States, they announced or provided these numbers recently, that overall the unrealized losses in the US banking sector are 620 billion. That's a lot. But now with the FDIC adding support for SVB and for the Signature Bank and the Fed as well, so the risk that other banks, even though they might be a bit stretched right now, come into a situation where they have a liquidity crisis, where they have to fire sale some of their bonds, where they have unrealized losses in the books, that risk has been reduced. Of course, there's not 100% guarantee that not another bank will come into trouble, but like SVB was the 16th biggest bank. Like if, let's say, bank number 25 or 45 gets into more troubles, it shouldn't be as big as an issue as with SVB. Already because we have the measures in place. It might then again add stress to confidence and to markets. But I think normally, like that SVB challenge is kind of addressed. But never say never. And of course, we monitor also here the development very closely. So just quickly look at the questions. It doesn't seem any new questions coming in. So then, thank you for joining in on so short notice. We are here for you. We're happy to discuss with you any implications for your financial situation and your portfolio in more detail. My colleagues, our client advisors, will be there for you. Please reach out if you have any additional questions. And I hope next time we talk, it will be a bit more positive, and we will talk in a situation where confidence is definitely restored, and it's a bit less stressful as it has been in recent days. With that, thank you once again, and enjoy the rest of your day. Take care.